So I've just sold 4 of my dividend stocks. Not because they're bad companies, they've actually returned me quite a lot of growth, but because they don't really fit in the £1 million plan for this dividend portfolio. Realistically, as the long-term game goes, by the time I'm 50. Today I'm going to show you what I sold, why I sold them, what I've replaced them with, but also why Bitcoin and potential other blockchain related stuff will become very, very important as we blend, hopefully, appreciation into dividend income. If you like this sort of thing, or if you want to follow along, please do leave a like and subscribe if you want more dividend related content, personal finance content, and more importantly, investment tips. Now, if you've not yet done so, please do leave a subscribe on the channel. I know I've just asked you, but I'm pretty impressed with my journey so far. I've only been doing this since the end of June, realistically. But let's talk about the obvious in the room. I want to talk about my portfolio. And I want to talk about the fact that not lots really changed in terms of investment. I've still got an allowance there of 8,259, all things good considered. But why I made these changes is important. Now, I don't want to capture people's FOMO and imagination with Rolls Royce here. But what I'm saying is I had too many holdings and I wanted to have a diluted focus on the obvious top quality in my viewpoint. And I'll go through a lot of tools to showcase the quality of these stocks with some obvious stocks that are kind of strong dividend growth, but they didn't really have the yield, which was an important factor. So the ones that I've got rid of were strong, they were good, they were healthy, but they had very, very low yield. And I don't want to wait 20 odd years for them to grow and to give me appreciation. I'm optimizing now for yield and simplification with fewer names and more weight behind the convictional picks, alongside utilizing the all world fund and also a blockchain fund alongside Bitcoin and Ethereum ETNs, where profit will be taken and put straight into the dividend fund as it grows, as I get older, all that kind of good stuff. So I'm hoping that all kind of makes sense. But the overall goal of this challenge is the ISA to 1 million, right? And at the end of it, hopefully dividends, hopefully paying me 5 figures every single year without fail, fingers crossed, without it blowing itself up. So why I made these changes and which stocks have I sold? Let's talk about the obvious in the world. Halma, great business, very, very good, but it has a very, very low yield, 0.65%. But overall, as I've alluded to before, each individual stock that I've sold has made me money. It's made me some good money, realistically, considering this was only 2% of my portfolio at one point. But you can see in the middle, £17.66 dividends received, but overall growth, 441. Absolutely brilliant in terms of growth, 10%. Not too bad at all considering the time duration that I've had this stock, which isn't that long, since June time. But yeah, it's an obvious one really. But as you can imagine, this is why. Another one is Diploma. 1.13%, and again it has made me some solid money. £557, it's 13%, and overall the dividends received, none. Didn't receive any dividends. So yeah, you see the difference here. Now, a really good stock and a stock that I actually use is AJ Bell, but their dividend yield is relatively low. But more importantly, there's different metrics here. The dividend growth has spiked a lot. It's probably going to come back down. But I actually made a decent chunk on this, £690 in terms of profit. I've made £31 in dividends. So yeah, you can see a little bit of a pattern forming here. The final one was a really top stock in my viewpoint, but I also do think that the world of the wars and certain things may settle down a bit. It may well affect this. Even though it's a good stock, it is, I think, pretty much, I wouldn't say overvalued, but it's up massively. So I've decided to lock in a lot of the profits on this, and £1,154 profit, 12.5%, but again, only £71 in dividends. So yeah, you can see that, yeah, made some money here, that's fine. But some other stocks that I hold are getting 3 figures in the dividends every single time, and the returns are still just as good. But as I say, all these companies are absolutely brilliant. If you are looking for a longer term plan for dividend growth investing, those 4 should really be on your list. But I'm optimizing now for income growth and simplicity, not just price appreciation. I want to have a little bit of fun, but ultimately understand that I can make decisions a lot earlier and not worry about as many stocks, keeping it easier. Now, I replaced it with a solid one in my viewpoint: higher yield, solid track record, and dividend consistency. It fits the income compounding machine model better. There's less diversification, more conviction, more clarity. I use Admiral as a service, and it just makes sense. This is a really strong company. It doesn't look great in terms of the numbers, in terms of the value side of it. That's growing because I think it's undervalued. It's going to probably go up. Quality could be a little bit better, but the momentum's pretty good. Overall, in terms of the overall rank, it fits my portfolio model. And you can see overall with the revenue, it's increasing a lot. Their dividends has been increasing quite aggressively over the course of the last couple of years. So that's a good factor as well. So everything it kind of fits is really, really solid. And its revenues increased by 27%. Pretty damn good. So yeah, it's kind of an obvious one to pick, and a lot of people do like Admiral. And it just fits that kind of nucleus mold of picking the obvious, picking what works in each sector, and more importantly, do they grow their dividends? Most of my stocks grow their dividends still. So when we look at my entire portfolio, kind of as a rounded thing, you can see just by my face, I hope you can see it, I have the QVGM rank, and most of them are really good. The lowest one is actually Phoenix, but Phoenix is a bit more of a gamble. It's more of a turnaround, but it's very, very good in the world of pensions. But Admiral is 75, Hilton Foods 75, and everything above that is 83, 83, 84, 89 into the 90s, right? They are all hitting the markers, and that's what you kind of want from a dividend kind of portfolio. That has got quality, it's got growth, momentum, and all that kind of stuff, because they are growing their dividend yield. They are growing overall in terms of their streak. They're not missing any payments, which is important, but also they're kind of like solid in their industries. Realistically, for the obvious part, we need that. So it kind of makes more sense. So the idea is to stick with the obvious and allow that to grow. But let's talk about the core growth side of it, because I remember when I first did a video about my overall plan for this ISA, and people screamed, you need growth. And I agree. So let's talk about what the plan is. You can see here on the pie, this is the main pie where I want most of my money in to when I'm 50, basically. I have moved my all world fund, accumulation fund, out of the pie. So that's simple. More capital will funnel into that for obvious global exposure, for growth. The plan is to introduce next year, and I talked about in my previous video, cryptocurrency related stuff, blockchain ETF funds, cryptocurrency ETNs, Bitcoin and Ethereum. It goes live in 2 days. They are tax free. I'm not going to be balls deep going in straight away. I'm going to wait until the cycle lows. I am a cryptocurrency YouTuber. I've been doing cryptocurrency for over 10 years now, and most of my wealth is in crypto. So for this part, it's a bit of fun, right? I'm learning as I go, I'm having fun with it, and I'm enjoying it. The problem is people jump in the comment sections thinking I'm not very much into the growth side of it when I've got a bag load of Bitcoin and I'm pretty much financially secure for the rest of my life. It's pretty important to note that, but I want to leverage this in the tax-free side of it. I often said in my last video about the fact of Bitcoin and Ethereum in your ISA. Yeah, it's great. It could be tax-free, amazing, if you are going to get profit from it. But it is a lot harder than any other market. The situation is, what if there's a custodian problem with those ETNs? That's probably more likely versus the ETN itself failing. So just be mindful of it. But there is an element of skill curve that you need to buy Bitcoin and Ethereum. With the ETNs, it will make it simple. And buying it on, say, here would be brilliant. But the plan is, as I say, I've got one blockchain fund that I want to buy, which has got a lot of Bitcoin miners and AI stuff and companies that I use in Bitcoin treasuries. They're doing really well. That'll be a fund. Diversification. Bong. With about 40 different stocks in it. They will probably expand as they go. And then obviously Bitcoin and Ethereum. They will be risk parameters. And the risk parameters will be very, very simple. I will be literally having 20% of the portfolio literally in that high risk side. Most of it will be in the FTSE All World. And then the rest of it will be in the dividend side. This is the stats. They have improved a lot. The passive income was about 2.2% in the last video, I believe. And obviously with removing, a lot of stocks and adding some more, it has increased the annual revenue a lot more. It has also made a lot of other things happen, which is important to note. So, for example, in terms of my goal, we are still looking at 2039 for roughly, give or take, 2038, 2039. if we're going to be maintaining it on the current 13 point whatever percent return every single year, which is very high and is probably very, very unlikely to happen. However, as you know, there's some elements of caveats to this. There's obviously dividend payments are going to be important, but more importantly, what if those blockchain funds do well? What if the Bitcoin ETN does very, very well long term, and I can then rinse, repeat, put profits into that dividend portfolio, and boom, amazing. But we'll see. As you can imagine, take it with a pinch of salt. But overall, with time, it should be absolutely fine. The main thing with this is there's less dividend payments, which could be a bit of an issue, but as you can imagine, I could still add as stocks mature or if I want to add more. But what I will say is this: it is still a very solid, diverse portfolio with a decent yield, considering every single one of these stocks, apart from one, grow their dividends. So we've got 4.39% growth, and only one of them, as I say, even though on the year it says 0, the worst one is actually National Grid. That is a 5-year CAGR of a lot lower than everywhere else. But realistically, some of the data can be a bit iffy on this platform. It's all right, it's good, but it isn't the best as, say, Stockopedia. But the reason why it's 0% is because it's taken a 5-year dividend yield. The reason being, basically, 2019, it took a massive hit. After that, it's been absolutely fine. So you see my point here. So in terms of dividend CAGR, the worst one is 0.91%. So every single time, they will grow. So fingers crossed, that 4.39% dividend growth over a 5-year period will just gradually just be still there, and the dividends will grow, yield on cost will improve. And one thing that I have done, which I should probably explain, on my pie, what I've done is I've set auto invest off. Why? Because there's a bit of a weird thing. When you get paid a dividend on trading 2-on-2 in your pie, it will reinvest the entire money into everything. What I want to do is add it to the individual holdings. So say, for example, if I get Aviva as an investment, I just go onto, say, Aviva, and then with the cash, press the buy button. Boom. And it will put it back into it. So I do it manually. I still have some cash that needs to go in, which I will do in a second. But more often than not, you probably find one thing that's very, very obvious here. When you reinvest your dividends, it's better off putting it into the actual dividend that you got it from, because then that will eventually, over time, it's free money, essentially, it's dividends. It will help your yield on cost because it is a zero cost value because it's cash inserted from the company. Whether the snowball analytics and stuff like that will pick up on that, but ultimately peace of mind knowing that you are reinvesting your dividends directly into the company, compounding it. So lessons learned, and I think this is very, very important. Simplification gives you some clarity, because if you understand the stock more and you're not worrying about them, you're probably going to be fine absolutely holding them. One of my other lessons is I don't want to be yield focused. Being focused on the yield is a bit of a problem. I want to have quality and overall payout. As much as the other stocks that are good, as I say, they didn't really offer me. Getting £17 dividends is not a lot realistically when you consider the fact that you got £2,000 put in them. And also selling is a part of the process. I highlighted the fact that I was getting very few dividends from that for stock holdings, essentially. But ultimately, I've made over £2,500 in growth on them, which is absolutely fine. But as you can imagine, the long-term and compounding power may not be there, but I have rectified that and I've allowed the portfolio to grow in other ways, which should hopefully help it grow faster, technically. But the main thing is this portfolio is built for income stability and mental peace, because as I say, I'm going to be adding high risk stuff to this compared to my, alongside my cryptocurrency stuff. So it just makes sense. So there we go. Fewer holdings, higher yield, a clearer path. I'll keep you updated as we go. I will be adding a lot more stuff into this in terms of funds via the next couple of months and certainly next year with the crypto stuff. Also watch this playlist here. Help you with some beginner stuff if you are new to this.